All right. Hello, hello. It's good to see such a full room. Today we'll be talking about the fundamentals of credit, which is a fascinating topic. So I can tell lots of excited faces here. So first off, a little bit about me. I'm back at FinTech DevCon. Thank you everyone who's sponsored and put together this event. It is one of my favorites. I'm at Lithic. I lead the product team there. We do card issuing via our APIs. We also have a consumer product called privacy.com, where people like you and me can create and manage virtual cards. Before this, I was at Plaid. Before that, I was at Coinbase. And way at the beginning, I was born just down the street at St. David's Hospital in Austin. So, Austin native. All right, so going back, setting the stage a little bit, why talk about the fundamentals of credit? When I was thinking about what talk would be really useful for this audience, the reason this came to mind is that I've met so many creative people who know a lot about credit card payments, know a lot about the way that cards work, the way that payments generally work, but they get tripped up on all the other things that you need to make a credit card program really work. And so that was the genesis of this talk for me, is setting the stage for many entrepreneurs who want to launch a credit card program to really get those basics right. And my hope is that by listening to this talk, I will be able to save you some headaches down the line. Because if you do get those fundamentals right, you're in a much better position to scale your credit card program. Okay, so what are we going to cover? First, why credit? Why is there so much interest in this space? Then I will go through 7 of the key pillars of credit, the things that you really need in order to launch a credit card program. And then putting it all together, like this is kind of the heart of the presentation, is how can you put these pillars together in a creative way so that you can create the user experience that you are envisioning. And then finally, tips and traps. What are all the things that could go wrong? What are all the things that hopefully you get to learn now and not when you have your customer support agents just pulling their hair out? And we'll cover some of those. And then I'll try to leave, if I can time this right, I will try to leave 5 or 10 minutes at the end for any questions. Okay, disclaimer from the lawyer in the house. When I ran this presentation by him, he was like, man, you really picked a hairy topic. Well done. This isn't legal advice because I'm not a lawyer. You should probably talk to a lawyer. But I'm putting this here so that I can actually say stuff and not have to caveat every single slide. Okay. Credit cards are having a moment. Maybe you have noticed. And there's a number of reasons for this. One, people need more spending power now. That can be companies, they can be consumers. They're having to float their expenses, and they're looking for better ways to do that. There's also regulatory pressure on debit card interchange. So one of the things that we've seen is people wanting to offer credit for the higher interchange opportunity. So that's why there's this kind of reemergence of credit cards as a really interesting product that companies are thinking about launching. And why credit cards specifically, even compared to a debit or prepaid option? One is user demand, as I just talked about. People want access to credit. It increases the ability and willingness to pay. We've seen this particularly with the buy now, pay later explosion and the ability to increase cart value through that. There's also increased acceptance over prepaid and debit because of the nature of credit products. Merchants can sometimes prefer credit products because they know that they'll get paid for the full amount if they're going to charge it in increments, for example. And then from the issuer standpoint or the card program standpoint, it is a higher interchange opportunity most of the time. Okay, so credit comes in many flavors. When I talk about credit, that can be targeted at different customer types. It can be commercial, small business, consumer. The reason this really matters is because regulators care a lot about who you are offering credit to. And then the credit type can also be of many flavors. Revolving is kind of like your quintessential charge it model, and then you'll pay it eventually, and you have some interest and fees associated with that. Then there's secured, where you're putting collateral in order to get a credit line. So you're actually giving your card program, your card issuer, some amount of money and saying, I'll spend less than that generally. And that might help you build credit, for example. And then there's charge, which is not going to charge you interest, but is going to enforce that you pay back your balance before you're allowed to spend more. And then a common question that I've seen is, man, which of these fancy elite business preferred fancy schmancy things can I put on my credit card that I want to launch? And this really comes down to the network product. And the reason that I've found people so interested in this is because they can make more interchange off of that. Often the networks have set different interchange levels for a Visa signature or a World Elite business than some of the more standard card types. The interesting part of that is they've also set mandates on what you have to offer back to your cardholders. So if you are going to offer a World Elite business, you have to offer either some rewards, some insurance, some perks that go along with that. So it's not just I'm going to stamp it with a World Elite business and then I'm going to make more interchange. It's not that simple of a calculus oftentimes. Okay, so the reason I was particularly excited to talk about credit at this conference is the credit card landscape is significantly more regulated and complex than debit or prepaid. So this is just like an especially juicy topic, and we'll try to cover as much as we can today. There's, the reason behind that is there's a long history of mistreatment of consumers by offering them credit. We all started with this like, drop a bunch of credit cards in people's hands and see what happens. And we've come a long way from that. And regulators have really stepped in to protect consumers. So even though it is very complicated, it's at least for a good cause at the end of the day. And the sort of manifestation of that in this talk is that it's highly specialized. Because there's so much regulation, it is very difficult to be an expert in all parts of the stack. And that's why it's very rare to see somebody handle all the, what I'm going to call the pillars of credit. It's oftentimes somebody is handling a specific pillar and doing it very well. Okay, so just to recap, 2 years ago I gave a card payments from swipe to settlement talk, and I went deep on the left-hand side of this slide, which is basically how does a card payment work? And it works through these two sides, the acquiring side, which is the merchant side, and the issuing side, which is often associated with the cardholder, the spender of the money. And they're connected by the networks. When we add credit to this, there's really just this black box of credit. And the way that I've conceptualized it here, it's a bit more complicated than that, but the way I'm going to talk about it in this presentation is that it's really on the issuing side. So there's plenty of other kind of, especially point of sale or buy now, pay later that comes in on the acquiring side. But what the focus of this talk is going to be credit as it links up with the issuing side. So what I'm going to cover is these 7 main pillars, starting with the capital, going to underwriting, the lender of record, and then we're going to touch on the issuing bank, issuer, processor as well. And then come to loan servicing and collections. So these are the main components. There's a lot in the ecosystem. So you might be thinking, where's fraud? Where's KYC? Where's rewards? There's companies that do just that. We are going to really focus on what it takes to create a credit card program. And those are kind of the bells and whistles that you could add on later. These are really the fundamentals of credit. All right, let's get into it. It starts with the money. Who is providing the money that you will loan out? That is the first question that you might want to answer when you're thinking about a credit card program. It might be you have balance sheet capital. Maybe you've raised a lot of money as a venture-backed company. Maybe you're a big public company and you have that balance sheet capital, and then it's your money. It might be a bank partner, so it might be one of these, such as Evolve, Lead Bank, a fintech sponsor bank. It could be a third-party capital provider that just focuses on providing people capital. So Jefferies, Victory Park, Goldman, they all do exactly this. This is a really important decision, and this is the reason it's the first slide here. Whoever gives you the money, the capital provider, is going to have a lot to say. You will be hearing from them. They are going to have a lot to say about underwriting, acceptable losses, the required rate of return. They're going to set how much you have to pay for your cost of capital. So this is really a good place to start your whole credit card journey. Next, underwriting. I love the creative energy. That's why I love coming to FinTech DevCon. And there are always people who are like, oh, I'm going to use AI, ML, and I'm going to look at social data, and I have this really cool data source, and then I'm going to underwrite based on it. And I was like, that sounds really fun, a fun way for regulators to shut you down quickly. And that is because it often boils down, especially on the consumer side, to FICO or cash flow. That is kind of what the regulatory landscape is at right now. If you're a particularly big company, you have folks on the team who can kind of get creative. You might be able to do something different than that, but just be really careful, because this is, again, like a lot of things went wrong. A lot of people did underwriting in weird ways, and that's why we have this regulation. Now, on the other side, commercial is way less regulated. So if you're offering credit to small, medium-sized businesses, you have a lot less to worry about, and maybe you have more room for creativity on underwriting. The thing that's not regulated, though, is distribution. So you know, where you're finding your card holders, how you're marketing to them, you know, this whole thing is regulated, but that's a much more nuanced discussion than the strict underwriting side. So who might you use for underwriting? You have your credit reporting agencies, of course. You have bank data like Plaid. You have aggregators of multiple types of data like Bloom. Then you're going to want to incorporate capital provider guidelines. Like I said, they gave you the money. They have a lot to say about the money. And then maybe you hire in-house experts, and they'll create policies for you. The other important component is tooling. So how you put all these data sources together and what sort of interface you're going to interact with is an important component here. So next piece is like, how would I actually build this? Like what do I even start to do? I just pulled a few screenshots from some of the products I mentioned. None of these are my products, but on Bloom Credit, really the thing to notice here is you're going to pick which SKU you're going to get data from. So this is, you know, some Equifax report is their example here. But you're going to pull that SKU, pull that data, and then integrate it with your underwriting model. You might also say, okay, hey, I have a lot of non-technical users in my company that are going to want to change this, or they're going to want to test it, they're going to want to do all kinds of things, they want to document it. So you might use like a sort of low-code, no-code application or kind of workflow builder to do this. So one key decision is like, how much do you put in code? How much do you use a no-code sort of interface for this? But there's lots of different ways to do it, and you know, while you have to be careful which data sources you're using, there are a number of providers who have really API-ized this for all of you. Okay, step 3, lender of record. This is where lawyers are especially critical. They're always important, but here especially so. The lender of record is the organization that is responsible for compliance. So at the end of the day, something goes wrong, it's on the lender of record most of the time. And they have a bunch of compliance that they have to take care of. So you really want to make sure that whoever you pick for the lender of record knows what they're doing on the compliance side. That I think is the biggest criteria for picking a lender of record. They need licenses. The licenses depend on the state. I did not know that when I started out, that states are really different about what they require. And then, it depends on who you're lending to. So once again, consumer, way harder than commercial lending. How do you solve this piece of the puzzle? It can be a partner bank. So it can be the same bank that you used, Evolve or Cross River, somebody like that. There are fintechs that do lending licenses as a service. Peer is one of those. You yourself, if you are the card program, you yourself can be a lender of record. But to do that, you will have had to go get those licenses. The other thing that I've also seen is, these startups going into states that have less licensing requirements as a pilot. It's going to be a weird product experience for your users, right? Because your users are going to be like, well, what do you mean I can only sign up in one of these states? It's probably not how you scale to stardom, but it might be how you start out, is by being really smart in where you can pilot. Okay, and then there's the issuing bank. There's always a bank, and this is that piece of the puzzle. So the bank is associated with that BIN, those first digits of the PAN, so you always know which bank you're dealing with. They're also called the BIN sponsor. They may often be the lender of record or the capital provider. You see those bundled together quite often. You could go with a fintech sponsor bank that's not going to be, putting their branding front and center, or the traditional banks, which you see like the Chase Sapphire. You know that this is like a Chase issued card. And then the issuer processor. So this is where Lithic sits, that's where I'm at. Transaction processing, still 8583, ISO 8583. So we're still doing the same thing. We get the messages, we clean them up for you, we send them to you. It is actually very similar to prepaid and debit. And I get this question a lot. It's like, okay, well, can you handle credit? And I'm like, yes, because it's still 8583, and we will pass it to you just like any other message. The interesting thing is that many issuer processors also bundle other pillars of credit. And so that's really the decision you need to make here is, do you want things to be combined together? Generally, that means less customizability. If you're bundling these different pillars, less customizability, less control, but hey, you get an all-in-one package in certain cases. So on the full stack side, I think Deserve is the quintessential example of somebody offering you all the pillars all in one place right out of the box. Not a ton of customizability there. On the other side is somebody like Lithic, where we will do just the issuing processing, and in between you have kind of every combination of different pillars being bundled together. So now, how does that really look? You'll probably want to build transaction level decisioning. So what that means is when a customer taps or dips or swipes their card, you get a message from your issuer processor saying, here's everything that's happening, yes or no? Do you want this transaction to go through? And so the really important questions to ask here, other than the bundling question of what else will your issuer processor do for you, is what fields do they give you? And then the code you're writing is really parsing all these fields, putting together some business logic, and then responding very quickly with a yes or no. So you have a few seconds to do this. You imagine your cardholder standing at the coffee shop. How long are they really going to stand there before they know that they can have their coffee or not? So this is the real tricky part. From an engineering perspective, this is where you want super high uptime, super reliable systems, low latency. You're running the business logic. You're responding to your issuer processor right away. If you don't want to build that, you might want to go with a more bundled solution. Loan servicing. Oh man, this is like, when I was starting to learn more and more about credit, because I was getting questions from folks who are like, oh, you do card stuff, right? I can ask you this question. And I was like, loan servicing, it's just math. It's just math. Like you have some balance and then you multiply it by an interest and then you have the new balance. And it turns out it's way more complicated than that. So again, because of regulation, it really matters how you calculate interest, how you update that balance. You can't just do whatever you want there, and it is math, but it's like math plus compliance, which is significantly more complicated than math. And so this includes like the loan amount, and then there's interest and fees. Again, it sounds simple. It is not simple. Like, this is like the mind-blowing aspect of this. And then, of course, your borrowers will want statements, and they'll want some portal, and and they don't just want it. It turns out, to be compliant, you have to give it to them by a certain date in a certain format. So that's what loan servicing really comes down to. Note on verbiage, servicing is generally, while the loan is still good, healthy, it refers to getting repaid and tracking that. Collections, which I'll get to next, is efforts after a customer is sort of out of the healthy period. They're sort of not in good standing anymore. There's lots of different flavors of loan servicing. There's Loan Pro is one example of general loan servicing, does a lot of different things. There's a couple of fintechs, or a couple of loan servicing systems that are specifically targeting fintechs, as far as I know. Canopy Peach. There's also banks, bank-targeted loan servicing, so they may also be providing a bank core. So depending on who you are, you might want to go with a different loan servicing vendor. And again, this can be bundled with different parts of the stack. So you may find that your issuer processor already has a loan servicing system, or you're going to use somebody that bundles all the pillars of credit. So this is an important one, and you want to match it. Like all of these things, you want to match it to your cardholder. So if you are primarily focused on consumers, you might want to find a loan servicing system that is really good for that, or for business, or for revolving, or for charge. That's kind of what you want to think about here. So this is an example from Loan Pro. This is, I just looked at their docs. I think we have some Loan Pro people here, so call me out if I say something wrong. But this is from their docs. This is what I'm talking about when it's like harder than math. Applause already, okay. That's touching. What I'm talking about when it's harder than math is like things that you would never think to do in math, like having a Boolean on like, does this payment pay off the balance? It's like, okay, well, I calculated it and then it's a 0, so that means it pays off the balance. No, that's like a specific thing that you're gonna wanna record separately. So that might not have occurred to you. It didn't occur to me initially. Or how you treat extra payments. So like, as it turns out, people may pay you more than you were expecting. And then, does this reset the amount that's past due? Because then I'm going to calculate interest differently. So this is kind of updating your system of record. This is the loan servicing side. This is how this would actually look if you were going to build a credit card program. Okay, collections. You can do it yourself. You can hire a third party. This, again, goes back to who are you offering credit to? If you're offering credit to people who mostly are going to pay you back, either business or consumers, collections may not really even occur to you. Like, okay, fine, a few people didn't pay me back. I'm just going to write that off as a loss and move on. If you're lending to a subprime segment, folks that are maybe going to require a bit more encouragement to pay you back, and that encouragement may in fact result in them paying you back, then maybe this is a place where you invest. So you have companies like True Accord, a bit newer, or Encore Capital Group. I was doing research for this presentation. There's like a ton of companies. Like, I could have filled up the whole slide, but I just stopped because I was like, okay. If you want to do collections via third party, you should look into all your different options there. And what they're basically going to do is they're going to reach out to these cardholders. They may negotiate some repayment plans. They are going to sort of like manage all of this, track all of this for you. Again, something you could do in-house if this is not as big of a concern for you, or you can outsource. Okay, we made it through all 7 pillars. Very exciting. Now to the putting it all together part. Bundling the layers of credit is how you're gonna meet your specific needs and create the user experience that you have in mind. So there's this general trade-off that I alluded to before between speed to launch and customizability, or that fully bundled solution and complete control over everything that you're doing. You can build a credit program based on what your team wants to achieve. I think that's what it all comes down to. What is your ultimate goal? And then you like mix these ingredients together and hopefully create something edible and compliant on the other side. So some examples of this. Maybe you want to launch a pilot program ASAP. Like you're trying to get to demo day, you want to prove that this thing works. First, you want to consider what do you want to prove with that MVP. Maybe it's simple and less capital intensive than what the full scalable product is going to be. You might want to target a super credit-worthy segment of your user base. So if you already have an installed base, one good thing to do is some analytics to say, oh, these are my power users. I know these are the users that have money, and they might also want credit. They may also be really loyal to my brand. You could start there. You probably want to pick a bundled provider. So somebody who's going to do all the compliance, give you the capital, the licenses. And then if you need to put your own capital on the line, this is where you want to say, what can I afford to lose? You know, sort of like going to Vegas. I don't go to Vegas, but I hear about it. And that is what they tell me. It's like before you go to the casino floor, you want to decide how much cash you want to bring, and you only bring that much cash. So that's similar to launching a credit card program. Maybe your goal is to build a highly scalable, customized program. You know this is going to work. You're maybe a more mature company. You have built a team that has done credit card programs before. Then you might want to consider best-in-breed providers. So you might be willing to go with a different vendor for each part of the stack. You're like, I can handle 7. There's going to be more than 7, but I can handle 7 different vendors. And I really want to lean into my team's competitive advantages. So that's sort of the mindset here if you're building this scalable, customized program. The other thing on this is it pays off, at least from what I've observed other people doing, it pays off to have multiple capital providers, both so you know you can get your cost of capital down and to give yourself runway to grow your card program. Okay, and then there's a third archetype to talk about here, which is you want to offer a card to drive loyalty. You're not in the business of a really inventive credit card program. You just want to have your, airline card loyalty thing because everybody else has one. You got to get yours. You want your logo on there. But it's not, you're not like trying to be creative with underwriting. Like this isn't your passion. It's just another product line. In that case, there are co-brand infrastructure providers that specialize in this. That might be a good choice for you. And then you want to just do the math really well on this one of how much do you want to give back in rewards? How much do you want to spend on marketing? How much does it actually drive loyalty to have a cardholder versus a non-cardholder? That's one metric that I've seen quite a bit. Okay, and then some cool examples. So this one is a bit historical, which is Capital One. They actually had this spectacular rise to success. They were kind of nobodies. And then they figured out how to do credit underwriting via data. And it was this kind of like aha moment for the credit card industry. And they proved that by doing 2 things, you can make a lot of money. The first thing is attracting the right customer segment. So what they did is they had advertising targeted towards people who carried balances on their credit cards. And so what they said was, bring your balance over. It'll be 0% interest for 6 months. And so if you don't have a balance, that doesn't get you anything. But if you are carrying a credit card balance, that's a very interesting offer. And so what that meant was they preferentially attracted a cardholder that was carrying a balance. And it turns out that that's a pretty profitable customer segment because you make a lot of money on interest. But the second piece was they also did underwriting in a way that they brought on cardholders that were actually likely to pay it back eventually and pay back enough for the whole program to be profitable. So that's the genesis story of Capital One, was they figured out who they wanted to be their cardholders, and then they went out and got those people. They didn't just say, come one, come all. It was very much around those revolving balance holders that their marketing was targeted. Then there's Costco, everyone's favorite. And this, to me, really proves distribution is everything. I mean, ultimately, you're offering people money. It's like the ultimate commodity. And what is going to make your money more relevant than somebody else's? And for Costco, it's really access to this super prime segment of Costco members. So if you think about, like, you know, maybe you're about to start a company and you want to go after that segment, good luck. It's really expensive to target to this highly affluent, highly likely to pay you back segment. That's, you know, everybody kind of wants those customers. And for Costco, they have them already captive in their warehouses. And so they can just market to them. They have their phone number, they have their mailing address, they have them like eating pizza out of their hand. So I think this is sort of the genius of the Costco City card here, is that they, again, picked their cardholder in a very smart way. And so that's probably, you know, they didn't tell me what their loss rates were, but I suspect that that's what's giving them low loss rates, which makes them much more profitable. Okay, so on to our final section, which is common traps, some tips along the way. The most common sort of misconceptions that at least I've come across. All right, first one, I'm a product person, so of course I'm gonna say this. Start with the customer value, not the revenue opportunity. So I really, you know, I have a lot of these conversations with folks who are like, you know, they see 2.65%, and that is the interchange they're going to make. And they have done their calculations. They know how much their users are going to spend, and they have multiplied that by 2.65%, and it's a great number for them. The tricky part with that is why are your users going to use your credit card? So this goes back to the money as a commodity. How do you think you're going to get that overarching transaction volume? And what it comes down to is you're going to have to incentivize your cardholder to spend on your card. And to do that, you're probably going to have to give them money. So then that detracts from the 2.65% that you were going to make. I'm sort of making that up as kind of a high general interchange rate, but you know, it's going to be offset by the rewards that you have to offer. And then launching a credit card is also very often a major project. So if the whole name of the game is those interchange bips, it may not be worth it, which is kind of a weird thing to say, but you know, it has to drive some more customer value. Either that stickiness, loyalty to your brand, spending more on other things. Probably that's how you're gonna make the math work out. This is, you know, this is back in my sort of like consultant days where I would have a slide on the strategic value, and that's how you made the math work, is then you add the strategic value kicker, and then the whole thing is like ROI positive. That's what you're gonna need to do, most likely. Be wary of overconfidence, especially in sensitive areas. I think this is, again, one of the things I love about FinTech DevCon, one of the things I love about all of you, is that confidence, like I'm gonna change the world, and like my product is definitely gonna be better. Love that energy. I would say do not have that energy when it comes to legal and compliance considerations. So I mentioned the lender of record being like a particularly thorny one. That's where you should watch out. More applause. Fraud exposure is the other one. So if you haven't dealt with fraud, bad underwriting is a good way to lose a lot of money and fast. So that's when you're offering money, people flock to you. Move fast and break things is a joke in credit. Every time you want to change anything, your interconnected web of stakeholders is going to want to chime in. So if you want to change, who you're offering your card program to, or the APR rate, or the intro offer, all these cool product things that you want to iterate on, your capital provider, your own in-house lawyers, your issuing sponsor bank are all going to have things to say. Probably the networks will want to chime in as well. Measure thrice, cut once is where you'll probably land. It's really about choosing those long-term partners. Like that's what I emphasize to people who I'm talking to is you're really starting on this major adventure with anybody you pick across these 7 vendors. I listed all these company names. You should really like them because you're going to talk a lot. And everything you're going to want to do is going to be a collaborative effort with anybody in those 7 pillars. So if you're like, yeah, I don't really like this vendor, but I can make it work, I would really thinking about doing a bit more in-depth research there. And then Reggie made me add this. You likely need a lawyer in-house. Yes. When people loan you money, it comes with strings attached. Isn't that the case? So, I also encourage people to think 3D chess instead of checkers. So if you're starting out, work backwards from where you want to be when you have a scaled program. So if you're thinking, oh man, once I have a scaled program, I'm going to have 3 capital providers, I'm going to get rates down, I'm going to have so much runway to expand my program. So what is it going to take then to convince 3 capital providers to give you money? What it actually often takes is having a high-performing book already. So proving out, hey, I know how to do underwriting. I've loaned to this many people. These are the loss rates. I'm in compliance. I have these policies. They're going to ask you all of those things. So if that's the ambition, you might want to say, okay, I'm going to have to prove myself. So this is the money that I'm going to set aside in order to create a proof of concept. And it's very unlikely that the capital provider will give you free rein over any of these other pillars, honestly. So once you're selecting a capital provider, you are going to want to make sure they match your vision and your customer profile. Okay. Acknowledgements. Aaron Frank took a look at this. Somebody once called him the king of credit, and I would +1 that. And then Nick Hill and Reggie from the Lithic team also took a look at this. So my great thanks to them. And that's it. Yay! All right, I think I have just a few minutes for questions, actually. So if anybody has questions, yeah?
So considering you probably come across a lot of companies trying to launch credit, how do you think the landscape is going to change in the next 5 to 10 years? What do you see as is there any innovation in credit, or is it same rewards, keep swiping, keep getting rewards?
Yeah, so the question was, what do you think is going to happen in the next 5 to 10 years in credit? What's the innovation, or is it going to be more of the same, incentivizing people to spend? I think the innovation will come from, the reason that I picked the Capital One and Costco examples is I think it's much easier to innovate on distribution and this concept of picking your customers than on any of the other pillars. So if I was going to focus innovation anywhere, that's probably where I would look, is who are your customers that are naturally drawn to your product, and then how do you offer them a credit product that meets their needs? So I think that's where we'll see more creativity in the next 5 or 10 years. Any other questions?
How much has banking crisis, higher interest rates affected the people that you see trying to go find a lender?
Yeah, great question. So the question is, how has the bank crisis, higher interest rates, impacted the ability of card programs to find a capital provider? Interestingly, I think it's always hard. Like maybe it was easier before '08, but in my opinion, it hasn't become harder. It's just become more expensive, if that makes sense, which, you know, when the interest rate is what it is, like that flows through the whole system. But it really comes down to just because the interest rate is high doesn't mean it's a bad idea. And people are still going to want to make a rate of return on top of that. So I think lending is still alive and well, but it is, as we all know, more expensive. Okay, maybe one last question. Yes?
For general tech companies, I'm curious what you think about the trade-off between going a co-brand route versus building everything full stack in-house. Where do you see that trend going after business starts over the last few years?
Yeah, so the question is, for tech companies, would you go co-branded or bring a lot of it in-house? And I think it, again, comes down to what you want to achieve. So if you do want to customize, you're going to want to bring it in-house. If not today, tomorrow, and so you should be thinking about that when you pick these vendors. If it really is like you're in the business of running an airline, then co-brand is probably for you, and that is likely to be a very good option for a long time. So I wouldn't shy away from either one of those. It just really depends on whether you think your competitive advantage is going to come from this card product that you're building, or it's, you know, something that you're going to bolt on once and for all and sort of leave it at that. Okay, well, I'll be here. Thank you again for coming to the talk. I really appreciate it.